Could be anyone. So do you have a reporting line back from the implemented policies back to the policies? So are the policies well implemented, and do you have a check the box? Can you track that back to the people who are accountable and responsible for that? And do you have an annual report or any other reporting back to all the stakeholders at any given point in time? Well, that is what makes corporate governance, control framework policies and implementation of policies a very difficult game. So corporates are under a lot of pressure to adhere to a simple question: are you in compliance with your value chain if you purchase certain goods in... Have a reporting line back from the implemented policies back to... This is my taped voice, guys. I think our technicians will help me out here. This is a very slow echo. Yeah, I was talking about reporting lines, and I...
It's open here. Oh, yeah.
So guys, I have to admit, I was not in control here. Ramon and I forgot we're taped in front of a live audience, and I think also the YouTube channel now can see there's a live audience because of all the noise, so that's good. So the reporting back is, I think, crucial in the way things work in an organization, but that makes it very complex because the society is more and more demanding to corporates. And I think that's just an essential part a lot of stakeholders forget. They think the corporates can deal with these issues ad hoc because they're always in control in each step of this channel. It costs a lot of money, it's a lot of compliance costs, and I do not believe that at the end of the day corporates run on just running compliance because they wouldn't be making money. So that's just setting the scene of the discussion of today. What are we really talking about? We're talking about my favorite chocolate pie. Everyone likes chocolate. So how do we divide up the chocolate pie called operating margin? This is a very simple way of doing it. I've said, okay, you have types of assets and activities type A, which is plant, property, and equipment. So how would I compensate that type of the activities? Well, I have a cost plus, or I have a return on assets. That seems fair to anyone who invests into a machine. They want a coverage of the cost, or they want a certain return on that asset, which is in line with the marketplace. Then you have category B, that's intangibles, and I assume that's the intangibles we talk about, and Stefan will highlight within the definition of chapter 6. What is the typical compensation for that? That's a royalty rate, if you own intangibles, or that's a return on investment. That's just 2 reference points to quantify the return on that. A third category has been created. That's part of doing business, and I call that the non-intangible premiums. Non-intangible premiums you could illustrate by talking about location savings. You could talk about synergies. And the question then is, who gets that portion of the pie? And typically you would refer to that as bargaining power defines who gets the C portion of the pie. So if you have 1,000 sales entities who purchase goods from 1,000 producers in Asia, maybe they split up the location savings 50-50. If you only have 5 here and you have 1,000 competitive sales entities in Asia, maybe the location savings go all the way back to the 5 because there's more bargaining power at the level of the 5. The next question is, once you have allocated A, B, and C, because that's the one slicing of the pie, you need the slices of the pie to be allocated to a country or a taxpayer within a country. So each legal entity has a portion of A, B, and C, and therefore claims a portion of this big chocolate pie. Well, that's really the discussion we are having today. It's not about chocolate, but it gets very close. There's a lot of confusion about what we talk about. Are we talking about transfer pricing today? Because there's been a lot of noise in the public domain. Starbucks have been going through a UK congressional hearings. There's been other companies like Apple. The CEO went up to the US Congress to explain, we're a good corporate citizen, we pay our tax the way we should, and we keep a lot of people employed, so everyone should be happy. But there's a lot of rumble and noise in the marketplace. So what I would like to address, are we talking about tax evasion and fraud, and is BEPS the measure to counteract that? Or are we talking about transparency? Is it just a matter of transparency? We still trust each other, but let's be more transparent in the whole game. Is it about tax avoidance? That's one of the statements made at the UK congressional hearings, where the lady in the UK said, you might do this tax planning and it might be fully legal, but we believe it's unethical. Well, that's a bold statement, because who defines what unethical is? That's a very hard bargain, and there's not a concept called ethical which is defined within the parameters of tax law. Obviously, if you pledge to be a good corporate citizen, there might be some ethical or social standards you want to live up to. At the end of the day, it's different stakeholders and different interests we're looking at. So the OECD might say we want to avoid wide income, and wide income is income not taxed anywhere. The NGOs might say, well, we want each company to report its corporate social behavior through a CSR type of reporting. Again, that's great, but the governments have not made up their mind how that reporting should look like. So, you know, in the absence of that standard, some corporates already took that very seriously, but there's no standard. So again, the word unethical in relationship to a standard is not developed yet. Public domain seems to not fully understand what we deal with, and that's a problem for us as well, because it's very hard to communicate to the public domain what we're doing and what is fair and what is unfair. Is it fair, and that's even a discussion in Switzerland, is it fair you pay 22% in the canton of Zug, and multinationals who do operations there might pay less tax? Is that a fair system? So there's a lot of emotions in that type of discussion. The UN, who's more representing the non-OECD countries, is putting an emphasis that location savings and certain market premiums Hello? This one works. Now I can sing. Yeah, it looks like a big one. The UN is more supporting places like China, who say there's a location saving, there's a market premium to get access to the Chinese customer base. So we need some of that revenue to be reported here. The corporate taxpayers, and I think we get the hang of that a little later when Alain and Andre will talk about it, they need a stability of management. They need to know upfront where they stand. So clear rules, clear guidance, otherwise they cannot be good corporate citizens. And they want to avoid double tax or above nominal tax rate liabilities because there needs to be some fairness in the way you get treated. The rules of the game, quite quickly, is it just about reporting correct financial data, or is it about the fair effectiveness and efficient tax systems? The OECD has sort of not made up their mind. Is it about transparency, so that the initiative country by country reporting even leads to, and I just take the example of the VAT information exchange system, which the EU already has up and running. Full transparency to all EU members on who is paying what tax in the EU to everyone. So that's sort of a phase of transparency which goes all the way to the stakeholders, although it's pretty one-sided because it goes to the stakeholder tax authorities. Are we talking about a change of the OECD fundamentals? We will have a few discussions about that later today, where certain facts are not that clear anymore if you do business in the cloud. So where should you be taxed? Well, there's some struggles on the concept of fact-finding, which is relevant for taxation at the OECD, and I think that's also part of our discussion a little bit later. If that difficulty leads to unclear rules, obviously you run into a lot of risks being a corporate, because very likely you're going to be taxed twice or three times on the same profit. Or is it, as we already addressed, the behavioral aspects? Just closing my introduction, 3 examples BAPS has brought to the table. Look at economic substance. The question is whether economic substance is what we, from a business perspective, label as economic substance, or whether economic substance is, in the absence of clear concepts, is something from a tax authority's perspective, only if I can put my hands on it, I can tax it. So then you're talking about assets and people in a particular country. Then obviously it's easier because you say the asset is here and the person is here, and therefore I can tax it. Chapter 6, and Stefan and I already had a discussion a few weeks ago in Brussels. If you say, okay, if I define intangibles, which is a big chunk of the chocolate pie I showed to you before, the part B, if I define that in such a way that I don't agree with the accountants, because the accountants cannot define intangibles and miss a lot of intangibles because they're not on the balance sheet, I agree with that. If the next step is I don't agree necessarily that legal ownership based on intellectual property law is relevant, I tend to disagree with that. So if you go, as the OECD seems to be doing, and you say there's a lot of economic co-owners to the intangibles, I have a lot of countries who I'm sure want another piece of the chocolate pie and are not necessarily the IP law owners. So I think that's another discussion and example which we will be addressing today. Last but not least, and that's coming back on what are the rules and name of the game, that's the transparency. France has just issued a new set of compliance rules, which you need to provide them with a digital file of raw data from your administration system, your ERP package, covering 16 fields. You cannot change the raw data. You cannot change the label of the data. You need to give it to them in a digital format. So that's what you give. Then subsequently they step aside. They have their own software to convert that raw data in a set of accounts, and they calculate the taxable income for you. This is a rule per 1/1/2014, and the French approach is also give me the information of the last 3 years so I can compare it. It's great. It looks like, okay, another wild plan of a tax authority, a little bit maybe overboard, but who cares? Well, if you don't have the information the first meeting, they come back 3 days later and you have to hand it over directly. Otherwise, you will receive a penalty, and the penalty is expressed as a percentage of the revenue of the company. So there's a quite big enforcement to get to transparency. Either you like it, if you don't like it, you have to do it anyhow. So with this, I'll give the floor back to Ramon and as a sort of scene setting and the context for today's discussion. Thank you very much.
Thank you, Steve. So actually, Steve mentioned some very important developments, topics. Good corporate citizen, tax transparency. Those are issues, if we would ask you 10 years ago, would it be a main issue in your business? I think many of our colleagues, including myself, would tell, no, this is not an issue, we are not dealing with corporate governance from a tax perspective. So, but if you look now to policymakers, like our dear colleague also from the OECD, this is the fundament of the base erosion and profit shifting project. So I will give now the floor to Stefan de Baats. And Stefan is advisor at the OECD and a transfer pricing advisor. Before that, he worked many years for the Belgian tax authorities. He is also representing the OECD at the EU Joint Transfer Pricing Forum. And besides that, he is also a special member. And there are not many people on this list. So he is an independent person of standing under the EU Arbitration Convention. So Stefan, we're very interested in your presentation. All right. Thank you.
Thank you, Ramon. And indeed, I always am a bit confused when people say I'm an independent person of standing. I never know what it means. But anyway, good morning. And I'm just going to mention the slides here. Oh, okay, Ramon will do it. My talk is going to be about BEPS, of course. And BEPS, well, is it going to be plain sailing or rather stormy weather? I think the timing is about right. And actually my talk is about these two little booklets. Doesn't seem that much impressive, but, well, there's some pretty good stuff in there. Some pretty hard stuff. Oh, that's me. So first in general, what's it about? And this is what I mean about the stormy weather. There has been, also because of the civil society, there has been a lot of talk, a lot in the press. We all know the stories, Starbucks, Google, Seb Miller in the African countries. They don't pay tax. Well, I don't know whether they don't pay tax. I haven't seen the file. So sometimes there may be a disconnect bit, but I know transfer pricing is very difficult. I've spent a couple of years in it. And, well, it's an art of making difficult things easy to understand. But sometimes when you read those press articles, it's going into a certain way, but you really need to have an in-depth look, and that's not what these articles do. So, therefore. But anyway, the message was out there in the press. Big multinationals, they dodge tax. Full stop, almost. That's the story. And then, of course, the politicians picked it up and said, well, that's not right. We all need money. Big multinationals make big bucks. We must get some part of it. Or at least we must get our fair share of it. G20 Summit, St. Petersburg. We drafted our plan, the BEPS plan, the first booklet, only 70 pages long or something. And then we drafted an action plan. This one was endorsed which was endorsed in June by the ministers of finance. And in the 5th and 6th of September, the G20 leaders said, We endorse this ambitious and comprehensive plan on BEPS, aimed at addressing base erosion and profit shifting with mechanisms to enrich the plan as appropriate. This is a highly political statement. But I think the next line was even more important. Profit should be taxed where economic activities deriving the profits are performed and where value is created. When this sentence is when this sentence is a political statement, this sentence goes really into the heart of, I'd say, transfer pricing. Where are the economic activities deriving the profits? Where are those activities performed? Where is that value created? This goes to the heart of transfer pricing. This is just an overview slide of what is. I won't linger too much on it because time is limited. 15 actions we have in the action plan, a couple of which are focused on transfer pricing, really specifically focused on transfer pricing. There are, of course, some spillover effects. And, well, the transfer pricing team at the OECD is only 5 or 6 people. It's a lot of work, I can tell you, for 5 or 6 people. But still, we are going for a coherent plan, alignment of taxation in substance, and coupled with transparency. At least these are the big lines that we are going to, or to try to follow. Work on the digital economy, whatever that may be, because the digital economy, Steve has already mentioned working in the cloud, but that's only one aspect. We have the companies like Google. We have the internet sales. Well, where is that sales actually performed? But also in simple manufacturing, transfer pricing is never in simple, but even in simple manufacturing companies, you can already have spillover effects of the digital economy by the way they are doing business. So this is really a vast area, this digital economy. There is a specific focus group dealing with it on VAT, but there are still spillover effects on transfer pricing where we will come into play. And by the way, this is very much work in progress because we have to deliver by September 2014, by September 2015. So nothing yet is final, unless we have to perform, of course, the action plan. Also, the development of a multilateral instrument. And why developing a multilateral instrument here? Well, there might be changes to the model tax treaty. There might be changes, well, there are a couple of thousand double tax treaties around. And if each of these tax treaties have to be renegotiated, well, you have country A and country B, and country A might have a position and country B might have a specific other position, whatever, and they need to come to an agreement and consensus. Takes a lot of time, at least 2 rounds to come to an agreement, and then you have to go to Parliament to ratify. It takes a lot of time. If you have to do that a couple of thousand of times, and then, well, I'm from Belgium, and you have a government not during 500 and something days. It's a world record, but I'm not proud of it. Well, it takes a lot of time. So therefore, the development of that multilateral instrument can be a solution. Work in progress, as I mentioned. Digital economy, this is the one action. Challenges of digital economy. Might be spillover effects on transfer pricing. The focus group now is working on it. Coherence. Hybrid mismatch arrangements. What are these? Well, like in the financial sector, you have an element that is taxed like a loan, and you have another element that is taxed like dividends. Equity can lead to double taxation. Certain circumstances can even lead to double taxation. These kind of mismatch arrangements need to be addressed. Strengthen controlled foreign companies. That's action 3. There's no substance over there, so let's strengthen controlled foreign companies, CFC rules. Limit base erosion through interest deduction and other financial payments, the financial sector. Here also there is a spillover effect with transfer pricing. There's a specific action in transfer pricing also dealing with financial. So we have to coordinate with action 4 on transfer pricing. Oh, sorry, I was too far. Counter harmful tax practices more effectively. Action 5. Harmful tax practices. We already had a report in '98 on harmful tax practices, so that's going to take a minute. But one of the elements here that's maybe in target might be patent income boxes. Might be one of the issues that they are going to look at. Another thing that's in Belgium, notional interest deduction. I don't know, maybe some of these things, these kind of structures that lead to very low taxation, whether they are in compliance with, say, international principles. 5 actions to align taxation and substance. Prevent treaty abuse. This is a difficult one, treaty abuse. Normally, when there is an abuse, you have an abuse of domestic law. And we're talking international, so you have at least two companies or permanent establishment in one country. And you have 2 countries with 2 domestic laws. And usually when you have an abuse of domestic law, leading into abuse of the treaty. Now, there are certain, not in all countries, but there are certain possibilities in certain countries that say there's no violation of domestic law in either of the 2 countries. But there is an abuse of the treaty, but not an abuse of domestic law, leading to non-taxation. And therefore, nothing's wrong. Because as there is no domestic law abuse, well, you cannot tackle it. This is the kind of situation that is, or at least we have to go with one of the situations that are going to be tackled there. When according to domestic law, when there's nothing wrong, but still it leads up to less than single taxation, as we call it. Artificial avoidance of the PE station, permanent establishment status. That's also one of the actions, so also a very difficult one. Working Party 1 and their focus groups are dealing with that one. And then we come to transfer pricing outcomes, and here, the next part of my presentation, actions 8, 9, and 10, I will linger a bit longer on these ones. So these are the heart of my presentation. Transparency. Well, yeah. We've heard that there is an influence upon the tax basis, costs, at least that's what's said. The countries lose a lot of money because of BEPS. But effective data, effective figures on how much it is, we don't have. So one of the elements is collect and analyze data on now how big is BEPS actually, and if we counter it, okay, what are the figures that we have additionally coming in? Disclose their regressive tax planning arrangements. That's something the taxpayer should do. When I first read this, just on a personal mark, I said, how is a taxpayer going to say he's an aggressive taxpayer? But anyway, it's out there. So you have to disclose your aggressive tax planning arrangements. Re-examine transfer pricing documentation. Again, also here is the link with transfer pricing. Country by country reporting, I will go a bit deeper into that later on. But as I mentioned, and I repeated, this is all work in progress, nothing final yet, no specific hard guidance yet on these ones. And then the fourth action here is make dispute resolution mechanisms more effective. And this is also important also for transfer pricing, but also for companies, because if it leads to double taxation, you need to have measures, you need to have procedures in place to resolve that double taxation, leading to single taxation, making them more effective. And then finally developing a multilateral instrument. These are the 15 actions. It's just a bird's eye perspective of these 15 elements. The action plan is available on the website, so you can download it if you haven't already done it, with at least some explanation on what I just mentioned, just in a nutshell. The transfer pricing aspects now. Action 8. Develop rules to prevent base erosion and profit shifting by moving intangibles among group members. And there is already some action going on since 2011, 2010 on intangibles. Action 9. Develop rules to prevent BEPS by transferring risk among or allocating excessive capital to group members. Risk recharacterization, financial transactions. These are the ones that we are dealing with here. It's strange to see only allocating excessive capital. And what about thin capitalization? It's also going to be addressed whether we can, although consensus may be difficult to achieve there. Still, Action 9 only talks about excessive capital. Another one. Develop rules to prevent BEPS by engaging, or at least multinationals may engage in transactions which would not or would only very rarely occur between third parties. We think about management fees and these kind of things. Well, you won't find management fees between independent parties, but you will find management fees payments between related parties. So this is just an example of these elements. There are more, and I will come back to it. Transfer pricing documentation, country by country reporting, covered in Action 13. Action 4, spillover effect, pricing of related party financial transactions, loan guarantees, guarantee fees, interest rates, these kind of things, how to perform it. Implicit guarantees, these kind of elements are going to be addressed in Action 4, or at least spillover effect in Action 4. And then other spillover effects, for instance, with there may be other spillover effects also with other elements. Working Party 6 deals with the taxation of multinational enterprises. We undertake 6 projects. Some of them are linked, of course, so there will automatically be spillover effects. Complete the revision of Chapter 6 with a deadline of September 2014. So that's in some 10 months from now. Hard to value intangibles. So the really hard ones. And cost contribution arrangements, also maybe related to funding issues. Cost contribution arrangements on simple transactions and then cost contribution arrangements related to intangibles. We perhaps need to separate those different elements. Risk recharacterization and methods. We have now 2 sets of guidance. Control over risk and the financial capacity to bear the risk on risk, or at least that's on risk. It's not sufficient enough. We need to produce something more substantial there. Recharacterization, paragraphs 165 to 168, 169 of the transfer pricing guidelines. Well, if you look at part 4 of chapter 9, you will see that which also deals with recharacterization. You will notice it was very hard to get consensus on that specific area. So, the guidance there is very fluffy, I know. So we need to look at also at that one. Methods, we go with in the flow there. Financial transactions, capitalization, excessive capitalization, we need to look in. As you can see, these are deadlines already in 2015, luckily. So at least we can still have a life. And then transfer pricing documentation, including country-by-country reporting with a deadline of September 2014. There we don't have a life anymore. Well, that's our 5th project. And then base eroding payments like these management fees and other are also September 2015. With regard to the arm's length principle, and the transfer pricing guidelines confirm the arm's length principle, also the Committee on Fiscal Affairs, the CFA, said, well, formally apportionment is not a practical solution. in the time frames available for the action. So we are not going to consider it here under the BEPS project. What we are going to consider are, for those difficult cases where the arm's length principle does not provide a solution or does not provide a good answer, is, well, perhaps we might go beyond the arm's length principle. However, and I like the word however because it automatically turns everything around. However, it's not because it is outside the arm's length principle, and as I mentioned, this is work in progress, so there is no measure out beyond the arm's length principle developed yet. But it has to also resolve double taxation. It may not lead to double taxation. So if that measure is beyond the arm's length principle, well, we still need to be sure that all, or at least both contracting states in the treaty agree to that measure. Otherwise, well, country A says, I do what I like to do outside the arm's length principle, state B does the same thing, double taxation. That's not what we want. So there may be issues outside the arm's length principle, but there we need to agree upon which measures they are. Intangibles. Action 8 of the action plan. We have a revised discussion draft. We had published in June. We had a public consultation in November, the 12th and the 14th, including a 1.5 day or at least one day on this discussion draft. Some issues that are still remaining. Well, what's an intangible? And Steve mentioned the chocolate cake. I'd say intangibles are the icing on the chocolate cake. The thing that comes on top almost. Very, very difficult. But what's an intangible? And Steve mentioned rightly, well, you cannot just look at the balance sheet. But also you cannot just look at patent law. It is a very broad definition, and the broad definition is there for a purpose, because we wanted to capture as much intangibles, hyphenated, as possible. So it is a very broad definition, and it gives some examples, it doesn't work with labels, but it gives some elements of what are intangibles, like patents, like know-how, like goodwill. And we are not out of the discussion of goodwill, because goodwill was one of the issues raised during the public consultation, saying this is not a public, this is not, at least, well, we have two positions. You have the position, it's not an intangible, and you have the position, it is an intangible. This is still going to be discussed in the next couple of meetings in March and May of 2014, whether it is an intangible or not. So there are still changes possible. Also, certain countries are not really on the same line that it is an intangible, so still some use to be expected there. The ownership issues. Oh yeah, and the other one, so we have some examples, illustrations of what is an intangible. We also have an illustration of what is not an intangibles, referred back to chapter 1. Comparability factors, like location saving, synergies, workforce in place. And it is not because it's not an intangible, that it cannot create value. That's something separate. And it's not because it's an intangible by definition it is automatically valuable. That's the same thing. It always goes both ways. But it's not because it's a comparability factor it does not add value. So, but it's different kind. It's dealt with in chapter 1. Ownership issues and legal ownership issues, and also Steve made already a reference to it. Well, yeah, the legal owner. Well, the legal owner, Steve, is only the legal owner. And what do I mean by that? Well, he can be in the Cayman Islands or in Bermuda, not doing much. The intangible is just a piece of paper almost. You can say, okay, here's my piece of paper. Transfer it to the Cayman Islands without doing it. I'm the legal owner. But who does the work can be somewhere else. And again, that's where the functions actually are. Referring back to the G20 statement in St. Petersburg, where is the value creation? This might be it. And legal owner, well, yes, of course, he's entitled to a legal owner fee. But it will not automatically mean the residual. That's the difference. Now, okay, legal owner, we just give a small, simple, routine return to the developer who manages. This is now going to change. We have now some important functions related, or at least in the discussion of some important functions related to intangibles. The development, enhancement, maintenance and protection of intangibles, which are the key generators of value for an intangible. And if the legal owner doesn't do that, well, if he does it, it's no problem. If he doesn't do it, well, he might still have a fee, but not the residual of the profit. Arm's length pricing and valuation techniques like discounted cash flow methods. Perhaps we need to go and look into that. Well, I know discounted cash flow methods in valuation of intangibles, they are already used now, although there's no guidance on it, but they are already used. We just need to have the guidance more in sync with practice, I'd say. But it's there. So perhaps we need... Now, the thing is with those valuation techniques is, of course, they are on a post-tax basis. Tax people usually work on a pre-tax basis, so that post-tax basis, we need to take it into consideration from both sides of the perspective, because transfer pricing always works from transferor, transferee type. So you can have tax effects on the transferor side, which you need to consider. You need to take into consideration then the tax effects from the transferee side. So you need to have it from both ways. That's what the guidance for now, the discussion draft say no more. And we don't have any intention to say more than take it into consideration if there are tax effects into the valuation techniques. How? Because this is so highly technical, we leave it to the valuators. And I think that's plain common sense. Funding. And also this spills over to risk recharacterization and methods, and also financials. Yeah, okay, the funder, well, does he incur actually risk, or does his risk is simply the risk of an investor? That is the discussion that we are having now. Maybe transferred to risk recharacterization and methods. And then recharacterization of transactions involving intangibles. Well, the first word says it's recharacterization of transactions. When can you recharacterize? The fluffy language of 168 to 164, 165 to 168, 169 may not be enough, may need to be revisited. How to value intangibles. I once heard Bernard Gross, and he's the delegate for Germany to Working Party 6, say, if you do not have a cap on intangibles, it's a hard to value intangible. So that means that 90% of the intangible, or even 95% of the intangibles are hard to value. At least according to Bernard Gross, and I'm just quoting him. I'm not saying I agree or I don't agree, but that's what Bernard Gross said. But there is a specific focus group on that. But also there may be spillover effects, as I mentioned here on the slide, to risk recharacterization and methods. We have a first scoping paper, confidential paper, to delegates. We have time till September 2015. Here we might go into these how to value intangibles, go beyond. We might need to have methods going beyond the arm's length principle. Well, automatically almost two methods come to mind. The first one, at least there may be others, and we ask delegates to provide us with input. The first one is, of course, based in the United States, commensurate with income. It goes beyond the arm's length principle because they look at certain date beyond the transaction and work back. Might be issues with hindsight and these kind of related things, so it might be a very tough discussion. But that's the first one, commensurate with income. It's an element that we might need to look at. The other one is also a bit of a discussion item. At least there are two positions. One say it is at arm's length. Another group of countries says it's not at arm's length. And what I mean is it's the German approach. on intangibles, where they say, well, you need to have this kind of range where you need to come in between. The German approach on intangibles. Germany says it's arm's length, and I think they stand alone. But it's a measure beyond the arm's length principle we need to look at. As I mentioned, we asked delegates to provide other ones if they can think of, but commensurate with income, and the German approach is or at least two examples of these elements. Also, risk and recharacterization. Again, that recharacterization thing comes back and back and back. And the role of cost contribution arrangements, and to reflect changes with regard to Chapter 6. And the funding issue, because in a cost contribution arrangement, as the guidance is now, you can have the funder, you can have someone, okay, here's my cash, and then you can have another party doing the work. In your cost contribution, say, on equal footing. Now, if we have the discussion in the intangibles section on the funding, and saying, well, they only have right to a risk-adjusted return on their funding, and then we need to look at the CCAs also. And you have simple CCAs, what I mean with simple CCAs, like the guidance of the Joint Transfer Pricing Forum on CCAs not creating like putting services or shared services, these kind of CCAs approaches, which are relatively simple. And then you have the hard CCAs on developing intangibles, on making things in progress. So perhaps we need to also to divide these things. Give some guidance on the simple ones, and give other guidance on the other ones. Work in progress, I mentioned. So these are lines of thinking we work. Risk recharacterization and methods, a hard one. Actions 9 and 10, September 2015. Also had the first discussion at our November meeting of Working Party 6. Well, what are the issues? And we have 3 parts: risk recharacterization and methods. And well, the guidance on risk is relatively limited. We have some guidance in 158. We have some guidance, I think, in 149. We have some guidance in Chapter 9. Allocation of risk can be modified. Allocation of risk, well, in principle, it can be modified by contracts. But then we have the substance approach. And when we talk about substance, the term substance in the guidance is used in different ways. Perhaps we need to consider these things. Control over risk, financial capacity to bear the risk. These are the 2 issues that are identified in Chapter 9. What are these factors? Well, might need to revisit them. Add some factors why this risk is important. The framework for analysis, the relationship between risk, functions, and asset. The functional analysis, how is it? Because now we say, well, at least risk is a driver of income. Is it still valid? Do we still need to consider it? As I mentioned, work in progress. We need to look at it. Relationship between work on risk and work on artificial avoidance of the PE status, like commissionaire, strip risk, are elements that there's a spillover effect between those 2 actions. Recharacterization, well, 164 to 169. This kind of language. Also, we use the word there, economic substance, but used in a different form than, for instance, in 158. So we need to align that. Methods then. Okay, methods. What arm's length principle very much relies on using comparables. What if you don't have comparables? And that is in a lot of cases. What methods do you use in such a case? Multi-factor profit split analysis in an integrated global supply chain. Some of the people will already say this comes very close to global formula apportionment. But these kind of splits, although I don't think it's a global formula apportionment because it's between the parties involved, it's not global. But these kind of things, looking at the global supply chain, looking at those multi-factor splits, are a possible way forward. Mentioned, work in progress. Sure, sure. Yeah.
Oh, sorry. Yes, on that piece, if you can just go back to the previous slide, Stefan. Thank you. Because you mentioned yourself, it's probably the most sensitive piece or the most contentious area potentially. So, what do you mean by multi-factor profit split analysis in an integrated global supply chain? Does it mean that it is to support a TNMM analysis or a profit split analysis, or do you think that the OECD wants to totally depart from the normal methodology which has been proposed by Chapter 123?
Yes. Thanks. Well, the multi-factor split, and as I mentioned, this is still very much work in progress, so I don't know how the final guidance will look at, and we have till September 2015 to work it out. But what we have seen is the way that multinationals work nowadays in a very integrated global supply chain, that is that the methods may not be as readily suitable. We need to take more things into consideration. We are not going totally to revise chapters 1 to 3, so the guidance on the profit split will be there, will still remain. But we need to perhaps give more guidance on what to do when you have this integrated supply chain. Need to look at that integrated supply chain and work from there. This is also about, well, who makes the integrated global supply chain? That's the company. That's actually looking into the company and how do they do their business. And how, in that profit split analysis, that multi-factors, what are the drivers, what are the different drivers in the global supply chain that are available, and work from there. Actually starting from the business perspective again. But this is, as I mentioned, this is all much work in progress. So we're still at the beginning of the process here, where this multi-factor split analysis will come into play. So the financials. It's hard to talk about financial transactions without addressing thin capitalization. Still, we know already from the past that there are several issues and differences of view between countries. What about the passive association? And we all know these things. Okay, on a standalone basis, you would have a certain credit rating, but because there's part of a group, they have a better credit rating. Passive association. Now we say, or at least the most approaches are, no fee. What comes out of it? Work in progress. Interest rates, issues on interest rate fees, safe harbor rates, these are all things that come into play. Countries, at least from the discussion, are seemingly happy with going also for some kind of safe harbor rates, facilitating or at least simplifying also some of the discussion. Related party guarantees are some of the issues, and then we go into more difficult stuff like derivatives, captive insurance, these kind of things, where we need specialist help. And also delegates are aware we need specialist help on derivatives, captive insurance, and these things. So I think, and it's good that delegates recognize we need specialist help there. What the report is going to be, well, there's going to be recommendations about interest deductibility on these financial payments, the effectiveness of different types of limitations, and also, well, transfer pricing guidance, because there's no guidance on financial transactions for now. Well, we had some attempts before, but because of the disagreement, we never made it, but it is important. I'm still a bit, on a personal note, I'd say pessimistic on thin capitalization issues. Well, not on thin capitalization issues, but on guidance, because of I think a very difficult one to get consensus on. But you can only be. Documentation. I'm almost to the end of it, including country-by-country reporting. Close deadline September 2014. We have already some guidance on documentation of Chapter 5, but we're going to revise it. We're going to revise Chapter 5. Based upon the white paper on transfer pricing documentation, which is already out there in the public, also part of the public consultation, discussed this white paper. But also in October 2013, there was this short memorandum on country-by-country reporting, which was also part of the discussion at the public consultation in November. Country-by-country reporting, it will not allow countries straight into taxation. That's not something it will allow them. What country-by-country reporting is a tool for, it will be a kind of risk assessment tool, saying, well, this is a file that it may be worthwhile to look into. These kind of things. We're working on a template on this kind of high-level country-by-country reporting, country-by-country reporting template. It's nothing final yet, but we are working on it, and then we will have. It will also be shared on how it will look like. But it's more of a risk assessment. It will not allow tax administration to go straight into taxation. That's not its purpose. We know business is some kind of reluctant to go into country-by-country reporting. However, at a public consultation, the representative for BX says, well, I don't think there's very much we can do because the decision has been taken. There's going to be guidance on country-by-country, something on country-by-country reporting. And the only thing, at least the representative from BIAC said, the only thing we can do is try to be cooperative and try to be as cooperative as possible. Implementation of transfer pricing documentation. Typically, this is something in domestic law. But we can give best practices, we can give good guidance on how such documentation laws can be, or at least can be introduced. And then, of course, there are also other interactions with these, with other actions. Other base eroding payments, September 2015. These are the kind of transactions that you do not see between independent parties. Usually, so the transactions where you don't have comparables. Well, low-value services, the GTPF, Joint Transfer Pricing Forum, already have guidance on it. We try to work on that, on the same kind of footage on low-value added services. Trying to give guidance. I mean, services can be difficult. You can have high-value services, but at least let us not spend too much time in audit, in documentation requirements on these low-value added services. So the issue there is to get the benefit test changed into a kind of benefit test light. Countries tend to keep to the benefit test, but at least let's not make it more difficult than it is. Management fees, that's something else. I mean, the real management fees or the fees for technical services, what are they? What is covered under those management fees? Maybe low value added services, maybe also be high value added services. These are the things we need to look into. The sixth method, what do I mean with the sixth method? It's an approach that is used in Latin America, usually for commodities, when you have commissionaires or entities in a low risk, in a low tax jurisdiction, where it's a kind of anti-abuse rule approach for commodities. Under certain circumstances, they can use the price not at the contract date, but at the date of the transaction, the date of the actual export. So there is a disconnect, although the price is set perhaps 6 months or even a year up front. We are going to look in, we don't have guidance on the sixth method for now. We're going to look into it. There's only one criteria, that is, of course, that you have to relieve double taxation. So in case of the use of a sixth method, there need to be room to go into a mutual agreement procedure to relieve double taxation. And then the last bullet says simplification linked to low value added services, simplification versus the actual demonstration, the hard demonstration that the benefit has been given to the recipient of the service. Other elements with the text. Oh, one thing I forgot on documentation. That is that we are also working on a two-tier approach, together with the country-by-country reporting, where we think that the country-by-country reporting might be a good tool to put into the master file concept. So we are also working on a two-tier concept, master file and country-specific documentation there, just on side. Other work we are, or at least spillover effects, digital economy, of course, working in the cloud, these kind of things will have an effect. PEs, attribution of income to permanent establishment, AOA kind of things. They are related to this. It's on the AOA. Just a little side remark. It is strange how certain. It's not the official point of view of the OECD or of the member countries, but it is strange that sometimes you hear that the AOA, the authorized OECD approach, was developed by applying by analogy the transfer pricing guidelines. And now the strange thing is that some people tend to favor applying the AOA approach to transfer pricing. So you got a circle. Strange that you would apply an analogy, or something applied in analogy, then apply it back to the one that's the original from. But strange. So I would not like to have that happen. It's strange because there are some differences. But anyway. Establishing methodologies to collect and analyze data on BEPS, maybe transfer pricing issues, documentation issues come into play there. And then, of course, dispute resolution. Like 50-60% of the cases on the map are transfer pricing cases. OECD does not have figures, specific figures on transfer pricing, but if we compare them with the figures of the Joint Transfer Pricing Forum and their monitoring, I think some 50-60% are transfer pricing cases. And that's it from my side. As I mentioned, just to recap, we have the 15 actions. A lot of them are transfer pricing or transfer pricing related. Some specific transfer pricing, other transfer pricing related. The work is in progress. Work on intangibles is getting near to completion. We need to deliver in September 2014. Actually, we need to deliver to the CFA in June 2014. Otherwise, it will not get approved. The other one is very much work in progress. Something is going to happen. Is it going to be a big bang? Well, the principles actually work, and work in a vast number of cases. Where we are looking at and where we are trying to get guidance on is on the cases where they do not work, where we have issues. And I think that's only, from our perspective and from the government's perspective, only a fair approach. It's not company bashing, it's not M&E bashing. It's about transparency from both sides, from the tax administration as well as from companies. Therefore, here I rest my case.
Thank you. Thank you, Stefan.
Okay. Stefan, thank you very much. So we all realize that the proposals of the OECD with respect to the BEPS project, with respect to the intangible project, they Test. Ladies and gentlemen, shall we start again with the next session?
Ja, maar om het te implementeren, dat is nog een heel ander verhaal. Dus daar is nog elkaar iets kunnen doen. Maar goed. Yeah, it will laugh at me.
Je mag gewoon aanschuiven. Je kan ook hier zitten. Je mag ook daarachter zitten, maar liever niet. Okay. So if everyone still wants to take a cup of coffee, just go ahead because it makes a lot of noise. Okay, so our next topic is corporate governance and CFO perspective. And the majority of the people here in the room, we are tax advisors, economists, tax lawyers. So we do not have to do anything with corporate governance, at least 10 years ago. But today, we've got a fully different situation. So I will briefly introduce the two. Eve Jordans, CFO, also CFO from TPA. And Professor van Enenaam, he's a professor of corporate governance among different institutions, also the George Washington University in the US. So Eve, floor is yours.
All right. Thank you very much. Ladies and gentlemen, welcome. This morning we heard an awful lot and seen an awful lot of technical details, as Raymond said. And how does this come over on a CFO? How does a CFO look at it? What's the job of a CFO? What keeps him awake at night? Etc. It's going to do an awful lot to him business-wise, but also private-wise. And believe it or not, a CFO is not a computer. It's a human being. There is no chip in him. The only chip he could have in his body is a pacemaker, and we don't want that. So what makes his life worth being a CFO? If you look to the CFO, and I've been playing that role in multinationals up till 12 billion, to smaller multinationals. What does it do? I was in that role when SOX came, 2001. And I was a tier 1 in a US company, so reliable in the US, protecting private money. Standing up in the US, explaining what SOX was and how we were in control. Fred, and let me introduce. When that happened in 2001, and I'm going to explain to you a little bit what the CFO role all contains. When it happened in 2001, when we had board meetings before that, I presented all the information to the board, and we had a good dinner with a good cognac. It was signed off, and that was it. And then SOX came. And the next year, they start asking nasty questions. Why are you doing that? What is this? Can we believe those numbers? Are you in control? And I asked myself, what's going on? 1 year ago, you accepted it, and now you're asking all these questions. Hey, it's me again, Eve. You remember your CFO? But we understand that SOX changed the world. And after that, corporate governance came. Fred, professor at the Nijrode University, I was lucky to join his classes for 4 years and hopefully understood what the new board program was, how a board performed, what they expect from a CFO, but what is also expected from a CFO in an organization. I'm just going to give you a few ballpoint CFO. As CFO, I had IT, the financial department, the tax department, the transfer pricing department, a part of human resource, a part of IT, you name it. If I would understand all this information till the bone, I would be a human being with an elephant's head. And I'm not. So you delegate this information, you delegate and you rely on others. You rely on your tax director, you rely on your transfer pricing director, you rely on your IT director. And then the question comes, are you in control? Can you sign off at a board meeting as a CFO, I'm in control? And believe it or not, in a multinational environment, you wake up in the morning with the problems of the East. And when you solve the problem of the East during the daytime, before you go to dinner, you have the problems of Europe and Africa. And if you solve those, before you go to bed, you have the problems of the West. And they keep you up at night. So when are you sleeping? Are you traveling in a plane? Oh yeah, I know that. Standing 3 hours on the front of the runway because the plane didn't do it. You miss your conversation with the street, as we say it. The shareholders meeting every quarter. So no financial information in a call to the investors. Now that's interesting. That keeps you awake. I was there. Does it do anything privately to you? Yes. You miss your birthdays of your children. You miss your anniversary of 20-year marriage and you have your secretary send a card with her initials from honey, thank you for 20-year marriage. You wake up in New York and says, please be aware, tomorrow morning your kid have a play in the school, be there. She's not asking you to be there. However, the board meeting in New York extended and you miss your last plane because you thought in 20 minutes you could hop over from a domestic flight to an international flight. That's no problem if the flight arrives at gate A1 and the international leave at A2. You arrive at Detroit and the first thing you say, it's reallocated to B76. Now, I don't walk the marathon, and believe it or not, there you stand on the airport, no luggage, no hotel room, and I can tell you those chairs are damn hard. That's happening. And believe it or not, then you come back the day after that at home, 2 o'clock at night, you go open the door, and you miss your kids. You think, I buy some new play toys, I buy a nice bouquet of flowers for my wife, and we solve it. You go upstairs, the kids have locked the door. On the door of your bedroom from your wife says, the left is the spare bedroom. But you know, your best friend, your dog, when you entered your room, or enter the house, your dog is in the bench. Normally he gets to you. But on this moment, he just stoops up, look you, his tail doesn't whistle, he turns around, show you his back, and go back to sleep. I can tell you, then you need help. And if everyone does not understand that message, there are typical criteria for that, but I'm not going to mention it because we have live streaming. This, ladies and gentlemen, is the role of the CFO. And then all this corporate governance, am I in control? Am I really in control? Can I delegate my work? And can I have confidence that the people that I delegate to give me the right numbers? And there is a change, and Fred will fill me in later on. There's a change from the boardroom, the audit committee. The audit committee will ask you, I want to verify this. I want to do a deep dive. I'm go behind you, and I'm telling you now, I will go behind you and go to the floor underneath you, the controllers, the human resource guy, everyone, and see if I can have confirmation of that data. Because the confirmation I receive now is from you. Can I sign off on that? So there is a change. There's transparency coming. Everything open. One issue which is involving a CFO and a CEO tremendously is media. Social media. Last week, the Minister of Economic Affairs in the Netherlands publicly announce by name 3 textile companies, Prenatal, Vibra, and Coolcat, that they were not willing to sign an agreement of behave and pay a more fair price for textile clothing in Bangladesh. It's not a law. She publicly did it on radio. The CEO from Coolcat, Fred, he was outrageous. But he had to sign 2 days later on. That's social media. Out of my own experience, one of my factories burned down here in Amsterdam, and a huge dark cloud went over Amsterdam. I got a phone call of the managing director, said, Eve, our factory's burning. Put the television on. I put it on. 2 minutes later, the doorbell rings. I open the door. I have a huge flashlight in my face and a microphone under my nose. Please, could you comment that there is no dangerous cloud in Amsterdam? What do? Say, go back to me in an hour? I'm not in control. It's the first thing on social media. If I say, no, there is no dangerous in that cloud, they're going to shoot me. That's the new reality. And I just explained it yesterday in one of the sessions, and that's going to happen. If you put a bucket of water on a Christmas tree, underneath it stays dry, because before all the water drops down, it stays dry. But what happened now in social society is that it starts flooding off the ground. We see it, what happens is people get more and more involved. If you put something and say something, they verify it within 24 hours on social media. And they burn you down to the ground if it is not true. We all know the examples. Rabobank, the CFO of Rabobank. You know, the LIBOR affair, 770 million fine they had to pay. The chairman had to say goodbye. Did it do anything to Rabo? Yes. Because this week they announced that normally the private certificates for the owners of the Rabobank are now going to be traded on the market to financial institutions because they have cash shortage. I said in my presentation yesterday, the CFO and CEO of Burberry, when the CEO from Burberry decided within 24 hours to Burberry, the clothing factory, and go to Apple, the share value and the stock market price of Burberry dropped down 720 million. Intangible assets, human capital, what does it do? Didn't they control the CFO, what the influence could be from such a person? Where do we go to? How can we measure that? All issues which keeps the CFO awake. If you hear that all, you would say, still they signed off. That's not good enough anymore. You should be in control. There's going to be a lot in the transfer pricing and with BEPS. We heard it all. It's not acceptable anymore that 1,300 young textile ladies died in Bangladesh. We should pay better prices. If it's fair, I'll leave it up to everyone here in the room. But things will be changing. Is a brand a brand? What is a brand worth? Discussions we will have, Stefan talked about it in Brussels, for a long period. But as a CFO, you're also part of the strategic planning. And could you give some examples, Eve? Yes, I can give. If I go in an airplane and I order a Coke, the first question they ask me, can it also be Pepsi? So Coke is associated with Coca-Cola. Not even the name, just the Coke, the word Coke. Can it be a Pepsi? If I want to go jogging, the first thing I say, I need Nikes. Not running shoes. I need Nikes. So what's the name word? What's the brand word? If I order a beer, I will go in a bar and say, I want a beer. You never call the name. Just want a beer. And the bartender will say, what do you want? That, and that. Different issues, which a CFO has to look to, the intangibles. And I can tell you one thing, and then I would hand it over gladly to Fred, is say, are we in control? Do we have it? Do I need answers? Can I do it myself? Do I need consultants? Well, I can tell you statistically, they did a survey last year on their multinational, small, medium, and large Who is the person you don't want to see in your office? Deep far in the 60% is at consultants. Surprised? So we don't want to be consultants anymore. From TPA we said we want to be solution partners, because I as a CFO need solutions. The CFO, I need to have to be taken care of. People should take care of me. The tax director should take care of me, providing me with the right information which I can adjust, which I can control, which I can monitor, and which I can present to the board and stand up. That's true. That's my guy or that's my lady. That's what we should have. Otherwise, I'm not in control. Do I take the challenge? Sure, I put the glove in the ring. Solutions, that's what we should provide. That's what I want. Answers, I can always get answers. And there are no stupid questions, only stupid answers. But I need solutions, you know? And then I stop. The last thing is that someone comes with me and we all recognize it. I have a problem. Can you solve it for me? If it is the tax director and the transfer pricing director and you ending up solving it. The next time you ask him, what is your answer? What is your solution for it? And he will say, never thought about it. Well, go back, think about it. Next time he comes back to you, this is the problem, I think this is the solution. Third thing you will ask him then is, did you solve it? No. Third time he comes to you, says, this was the problem, this was the solution, and I solved it for you. And the fourth time I don't want to see him in anymore. Because he's just going to report to me, everything is fine, I'm under control. Ladies and gentlemen, a warm welcome to Fred van Eenennaam.
Thank you. Can you help with the slides a bit? Sure. Yep. Great. I'll use the microphone. Or does it work this way? Can you hear me in the back? Yeah? So that's a sort of, if I can teach without it, it works. Or is this better? This is better? Okay, I will do that. Great to see you all this afternoon. I, of course, talking about governance and CFOs, I should first make all the zillion disclaimers. So number one, everything I'm going to present here are opinions, anything else. Don't try this at home. I will slightly exaggerate to make it hopefully a fruitful discussion and things like that. So don't try this at home, but I'll just speak my mind and you just try to do and see if it's useful. That's a different world, isn't it? I mean, 10 or 15 years ago, I wouldn't even start with this. I would say, let's talk about strategy, let's talk about value creation, let's talk about how we together how we increase the pie, how we share it better, and an effective tax rate. What should be the effective tax rate? And if you have our effective tax rate a little bit lower, good job. And for the rest, okay, it's okay in this board meeting that, bring in the tax guy for half an hour to explain to us some boxes in terms of how the different tax structures are, and everybody sort of nods wisely and ask an interesting question and looks at the CFO and say, well, okay, we think he was a good guy, and then they go away and, what is it? Don't ask, don't tell, or something like that. Or but that was sort of the situation. This is complex stuff, because if you're in a board, you really don't want to dive in deep on tax and on HR and on transfer pricing and on operations and on all the other topics, because you have an even bigger problem than the CFO. He's at least working 300 hours a week to try to get something, and you're just there a couple of days, and you get this stacks of paper. So nobody really cared, and that's transfer pricing and taxes. I mean, pretty hard, Yeah. So that's it's really techie stuff. So stay away from it. So that has been changing since 2003. So suddenly, in all the codes in the world, it said. Whether it was the UK code, whether it was the related Dutch code, whether it was something else, the supervisory board or the non-executives or the audit committee or whatever should at least pay attention to the tax paragraph. That was about it. And whether that was we have the tax guy in or whether we dive in deep, specified. But then, of course, that was the first time it really sort of oh no, wait a minute, we also need to look at tax, okay. So that's when that happened. And post-2008, let's say for the Dutch, post-ABN AMRO, post-Lehman, we don't know what we're doing. So we basically say, okay, this is a changing world, and how do we operate? And now I come to the CFO a little bit, and then I'll sort of introduce myself, dive into what I think I know of CFOs, but that's not a lot. But then I can talk a little bit about the interaction that I can see or observe between CFOs and how audit committee members, I think, generally perceive it, or what different views are from auditors and others, and see if that helps you solve their problems. So that's I think is what I found important to understand from CFOs, while I sort of spent some time on it for the last couple of years, was number one, in a board, nobody can be held accountable for anything except the CFO. The rest has a strategy, has an idea, has an opinion, has a process, has a framework, has a legal position, has a contribution, has a whatever. But it's only the CFO that everybody will look at no matter what item. Probably at the end of the discussion and say, you know, if you're the CFO, Eve, does it add up? Any problems there? Any risks? It's in the minutes. That goes to the tax authorities these days, so be careful with minutes, but you know all that. So this is the only person on every topic that can be held accountable. Nobody else in the whole board can be held accountable, or like external auditors, has a huge package of paper indicating that, you know, you told me everything I should know, and if you didn't, I couldn't tell anything else. That didn't fit, something like that. So that's important to understand. So the CFO only has the problem. The second thing is there's only one person in the company that's supposed to be involved in everything. The CEO, most of the time, what does a CEO do? Well, it's all unclear. Not smoking cigar. They do a lot of stuff. But it's I will show you when we were diving in what is a CFO doing. But after this whole charade, I thought, you know, you can better define it the other way. You have a CEO and a CFO, and the CFO does whatever, whole list. What does the CEO do? The CEO does something with the market, sales, sort of, and he does relationships. Whether it's the board relation, whether it's the, I don't know what relation, whether it's, not the tax, because that's technical. No. He does relations. And the rest is the CFO. And you can see that in our graphs, that the CFO has everything. And then during the 2000, we have some people from India, loved to have met them, you know. What happened with the companies in the western part of the world? They sourced out all this stuff on production and logistics and networks. So who should have a look at that? Not the CEO, because this is all contracting, isn't it? So who should do that? I think the CFO. So actually, I started defining the role. What's the CFO doing? And I'll show you some of the graphs. But this is a horrible job. It's everything except the two things the CEO does. So that's wonderful. I mean, they really, and they're the only one who are accountable. And the third thing is, who's higher, the CEO or the CFO? Who's in charge? Who? It's the CEO, really? I think so too. That's the idea, it's the CEO, but if you look at the formal angle of what the CFO does, you can bet that the CFO is actually responsible, especially in the US setting, for a lot and a lot and a lot and a lot, and actually is in a semi-role which is undoable. Don't quote me on this. No, it's a challenge, it's a dilemma, it's why you need training, you need grooming as a CFO, because you are expected to be working together with personal chemistry with the CEO on steering this company forward, because you need to have a team, and by the way, the CEO is the boss, right? On the other hand, the board looks at you and saying, well, you know, the CEO, we've read about all these CEOs that sort of had great plans and conquered the world, and so they also need to control the CEO. Sort of. But by the way, your performance is judged as a CFO by whom? CEO, maybe the chief audit committee, maybe the chairman of the board. So this is a great job, isn't it? It's unclear when you're successful, and it's certainly unclear who's really judging you. And then there is one final, that's the fourth thing, and for the rest, that's sort of my finding. There's one, and I'm going to quiz you on it. There's one person that every CFO should be afraid of. Who's that person? If you're a CFO, and I can deny it or say you're totally stupid, Fred, I don't care. But what I've seen when I interviewed CFOs, who should you be extremely mitigating? That's the board term. But I would say you should be scared for those because they want your job. Who? The external auditor. Maybe. Why would you say external auditor?
Because he's the one who can make sure that he cannot sign off the final accounts. So, and if the accounts are not signed off, the CFO loses his job.
Yeah. Okay. So this external auditor, especially, so the external auditor, if he doesn't sign off or needs to restate, you're absolutely in deep trouble because you're the only one who's held accountable on any board. So it's going to be the CFO, right? So that's going to be. He has the atomic bomb basically in trying to restate it. That's the sort of a thing, right? So, however, and especially more dangerous because now most auditors report to the audit committee chief, no longer to the CEO or the CFO. So that's true. So I put him on my list. But on the other hand, is it in the interest of the external auditor to get into an endless stream of restating? They'll try to avoid it. You really must have done a lousy job or for some reason your audit committee thinks they should save money on auditors. That's the most stupid thing you can do in a board. Save money on auditors, external auditors. It's really stupid. It's really stupid. I mean, it is sort of like buying in cheaply out. Let's squeeze out the auditors in terms of their hours and their things while the compliance goes up. What will they do? In the Netherlands, but I assume in the rest of the Netherlands, the auditor's view is at this point, the big firms I'm talking about, there's some new law coming up, or there's already in effect, I'm not really sure about, and that it means that every major listed and systems firm, so not only listed but also systems firm, need to have a new auditing firm every, 8 years or something like that. So the good thing now is that everybody needs a new audit firm in the next couple of years. Well, how many people do you think work at these audit firms? So they're going to cherry pick. They're going to cherry pick at whom they want to work. So don't. So it would be on my list to watch. I'll give you a plus on that. So external auditors, but they're not there, because where does the external auditor, let me help you a little bit. If the external auditor really sort of says, we must restate, where do they get their information from? Because that's the thing, right? We looked at that, it doesn't work. Some of our younger guys running around figured out there may be some fraud or things like that. But they are dependent on information. Who is the natural ally for the external auditor to get information that will lead to this? Controller? The controller's close, but you have the business controller and the financial controller. But they report to you. So you must be an insensitive idiot not to pick that up. But there is I'm just kidding. But yeah, then play another role. Work for a bank or something. But don't be a CFO. This is all on tape, right? So I can be quoted and go to my first statement. Who is paid to be the nuisance in a company to dig up all the dirt? Internal audit. 10 points. Internal audit. Any internal auditors here? Have a history in internal audit? Work with them. Very good. They're dangerous. You can work with them. They're dangerous. Because they're so I'm now running, I'm really happy with that, with some of my, I must say, academic good friends from the Harvard Business School who like corporate governance, and I'm always allowed to teach the Ahold case. That's the big Dutch corporate governance disaster, and that sells. So I'm really grateful for Ahold that they put me in the list of Enron and Parmalat, and that was great. I can talk about it. Everybody understands that, and they have Ahold listed in the US, so for them it's a US company with this bunch of idiot Dutchmen who didn't play the game right. Yeah? So they love the case. like I do. So that sort of lifted me up at Harvard. And now, without going for long, but I have sort of been allowed so far, next year is the 4th time, what we call Maximize Your Board's Potential program, and I'm allowed to pick what I think are the best cases and the best teachers at Harvard, put in a little bit of a European sauce, pretend I know anything, and then have a lot of fun for 4 days and talk with people around the world about what they do in boards. So that's where I learn. I create learning programs the best I can to learn from the people who are there, because that's to be honest, that's the real thing. I do a couple of things with strategy and governance cases where I think they're the best cases, or talk about it with boards. This morning I had a session for the Dutch people, the Vestia case. Vestia is a Dutch disaster. We also have very good governance, I mean, don't worry. But we have our fair share of everything. But this was sort of for the information of everybody here. You're all financial guys, right? So there was some company in social housing that was able to have on its balance sheet the value of the houses around 800 million euros, whatever the auditor put it at, 800 million euros. And that derivative position was 21.4 billion euros. The interest went down a little bit. They needed to pay 2 billion immediately. The rent coming out of the houses was 450 million. And fortunately, the banks kept financing this game for 7 years, with the final big one, the Deutsche Bank. Thank you. So we talked about how that could happen, and that's fun. It's not going to happen again, but we find a new way of doing this. At Erasmus, I'm going to talk with you a little bit about something they asked me to do that was sort of interesting. They said, Fred, can you help out with an executive program on the new CFO? And I said, I've never been a CFO. So now we have a CFO, you do the board stuff, and you seem to know how you do these programs. So I can talk with you a little bit about that. I did a new board program that Eve did that, which was basically to get people who are active in boards to think about the other side of the table. So it helps if you're a CFO to understand how an auditor's board member thinks. That helps. It's much easier to, and I could say as an educator, you must always learn the next role you're going to play. Don't go to a class where you learn your current role, you're too late. You must learn your next role, because that will make you good in your current role, and everybody will think you're already on that level. You there? This is propaganda, but you just know what I'm talking about. And I do something that was really scared of for a couple of years, to talk about board dynamics. You know, how people interact in boards, because it's an official play game and the literature is lousy on it, and I'm just an economist and have a family business background, and you know, scary topic, because all of the literature is about families how do they interact, or we have great literature on how in companies people react to each other, and effective teams or not effective teams, but in this little bizarre thing called the board, where there's no hierarchy, but there is hierarchy and all the other things, there's not a lot of literature on it, and most researchers are not allowed to look into that and tap people's brain and say, oh, what do you think of that person? So this is a scary topic, but I did it. So that's where I sort of come from. I promised to dive into my nice, and I'm sure you cannot read it, so that's why my student assistant did it this way, but this was my first thing. Okay, let's interview CFOs on what are they doing? And what's new and what's worrying? So new, if you're new in terms of being a CFO for the first time, or post-2008, what does it mean to be a CFO? So I did the wrong way, right? I just started looking at interviewing CFOs, looking at the literature. Erasmus paid for it. I went again to Harvard. I went to I have a fun life. I just ask people, I say, what are you doing? And I came up with, you know, make something of a list. So this is more or less it. Let me dive in deep. So a CFO is in the middle. The CFO is in the middle. So a CFO needs to understand business development, perspectives, strategies, and investments, right? You can spend your life on that topic. But you need to know that. You need to know in what economic cycle your company is. You need to know if the cycle for your company is up or down, and whether you need to adjust your budget. Because no CFO in the world can at this point say, let's do 3% more than last year. Because there's something like an economic cycle that varies per sector, that varies per part in the world, that varies per company. If you don't know it, I don't know what you're doing, but you're absolutely dismissed immediately in any strategic discussion. You with me? I can go with the whole cycle. So what is internationally going on? What is the macroeconomic cycle? How do we deal with the financial and the cash crisis? What about emerging markets? What about different risks that we have? What about international long-term development? What to do with China? So that's what. Then on the outside, we have the audit committee, we have the corporate governance regulations, we have the specifics of the supervisory board, we have the board dynamics, we have all kinds of institutions that for some reason also want to have data, influence, our sign-off. And they're growing. So this is the easy bit, right? So this is, Okay, then we go deeper and say, of course, you need to have an opinion on how is this corporation creating value. What's the new business model? Are we going to be more like Google or not? Where does the money come from? We're not making money with one transaction. We're having 10 different transactions. And how do we do that, right? And I'm the first to go, and then that person is to go. Or the other way around. Or even worse, the CEO was previously the CFO here. Oh, that's fun. Let's have a restatement of the tax file. The TNT case for the people that like that. That's fun. Merger and acquisitions, always fun. Incentives, schemes, you need to think about that. What are we going to outsource and insource, and how do we know we're in control with partners and contracts? Yeah. We all have the economic classes on there are no perfect contracts. So let's continue with that. Oh, then I need to know about how is my, what do I do with, this is also fun, real estate planning. Real estate planning. That's a fun topic for a CFO. What is the new building that we need to move in? Should we restate, should we ask one of the people to restate the value of our real estate? And one way, because my understanding is there are 10 different accepted methods of valuation of real estate. So this is one of the tricks that you can use in your annual report or not, or what you want to do. And this is a nightmare, isn't it? This is the old trick of people building cathedrals for themselves and killing your OPEX for the rest. You're a CFO, you get this great financial structure of a real estate thing, and then you look at your business. Where are we going to make the OPEX to get the real estate money back? This is killing companies. Yeah. So this is really funny to be responsible. Most of the time they are responsible for real estate planning. ICT, the Dutch is the only place in the world where we talk about ICT, I believe. The rest of the world says IT. But for some reason we put communication in, I don't know why. But that's a fun topic, isn't it? And that's a great story to bring to the board. Our IT projects. That's fun. Ever seen an IT project go on time? Everybody liked it. It did what it was promised to do. We understood what the budget was. We understood the business implications, either in our value chain or in our compliance, or we were anticipating enough the new technological advantage. While somebody talked about social media. Any fun with that? So every CFO I talk to is, please make sure you create a CIO, and don't let them report to you. Let them report to somebody else. Because this is the absolute disaster. Nobody knows. Nobody knows. At least, I don't think so. The sustainability issue, okay, we can talk about it. That is an all-confusing topic. Does it mean we need to do good? Or does it mean we need to make sure, whatever? Is it the shared value creation bit? Or is it we must do good? Or are we always on the moral, ethical high ground here? So you can only lose on that topic. And nobody's sure, at least I'm not, what it is. Pension funds. Isn't that fun? Isn't that fun? Some CFOs, until even today, are in the board of their own pension funds. That's smart. That's conflict of interest written all over your face. And then some companies have sold. Some CFOs should be blamed for it, as far as I'm concerned. But they have sold their companies based on the money in the pension fund, without explaining that it's actually, there was some vague idea that is money from the employees. We seem to have lost that idea. But some people have been funding based on my pension, their sales bid. Contracting, that's great. All the contracts, especially with banks. Isn't that great? To have 50 or 60 different loan guarantees with banks, and then if one goes through the minimum requirement, all are sort of open. That's fun. Refinancing. If you seem to love this stuff, I love to supervise this stuff, basically. But this is, and then you're supposed to understand your general ledger, your transfer pricing, the new company that you bought, the way you allocate your costs so that you can have performance measurements and the processes around it. Because there's a shift from saying being in control towards I'm sort of legally in control because I did a fair, correct process given the current state of nature. So you see more and more declarations, not that it's actually correct. No. Everything around it. I mean, the old COSO framework, 10 times over. That's sort of the statement, within reason. So this is a great business, if you like it. Then, of course, the balance sheet and the cash flow management. Of course, that's all. Cash flow management is clear, serious, absolute, number one problem, issue. It used to be simple, right? You go to bank and write risk, not upward potential. I'm not saying I hate this list, to be honest. I think it's leading us off from what we should do. But if this is their list, then this is their list. Then they talk about performance management. That's great, isn't it? Did you do well, did you not? Cost reduction, always there. Quarterly and annual reports and the auditors, so that's your part. So that's on 6, because it needs to be good. Strict corporate governance, and the keyword here is strict. We've moved away to comply or explain to comply or go to jail. Fun being a CFO, right? Including managing the stakeholders, mergers, that's always a great thing. And the processes around mergers, and most of the CFOs do that only a couple of times in their career, and it's becoming more and more a complex issue. But they need to sign off. Nobody else. One more issue. So this is fun. IPOs, of course, and the processes around that. Very interesting for CFOs that will be bought out by private equity firms and then be loaded up with their money as well. But most CFOs are pretty good at that. IT. And the introduction of sustainability. That's a difficult topic as far as I can tell. Introduction of sustainability is what is sustainability then here for this company? And what's the introduction? And most CFOs that I know have said, let's put something smart in the annual report. And we have the big 4, 5, 6, 7, 8 to help us out with some existing process. At least that's my perception. I'm not saying I'm right. So I said, I promised Eve not to do a lot of slides because I think you have enough of that. But this is sort of where I come from. Now, what do you want to know from me? You know what I absolutely don't know anything about, so that helps. And I can certainly talk with you about a couple of things, but is there anything you would like to respond to, think about, talk about, say, Fred, what do you think? Yeah.
Thanks, Fred, for a wonderful presentation. So how many percentage-wise of the CFOs is really in control? It looks like this is Superman 1, 2, and 3 together. And I get a feeling this is just overarching, and it's just the lowest point in the board. Everything falls in his lap. The surroundings change. That means all the deltas in his lap again. Right. So what
former CFO, so he's been swimming there. He knows, this cannot be done. All of the rest are general managers, let's say sort of CEOs, or people that have specific professional skills for whatever. Lawyers, tax lawyers, I don't know, German ambassadors, things like that. People that sort of are nice in the board. But there are only a few that have actually, and the key difficulty for CFOs today is find a good, respected CFO, Chief Audit Committee, who's also active as a CFO today. Because I'm sure in the 3 hours waiting for the airplane, they could do the audit committee work as well. So the chief advice for CFOs is become friends, and I don't mean it in a negative way, or become acquainted to the top 10 or 20 CFOs that chair audit committees in your country. They need to know you, and not when they have been appointed chief audit committee. If you want to be advising CFOs and you don't know these 10 people, you're in trouble. Because ultimately, the chief audit committee is going to talk off session with the CFO on who his advisors are. That's why McKinsey has way too much work, although that's not an audit. But it's because it's an accepted brand. Doesn't mean what they say. I'm slightly exaggerating. They're pretty good, to be honest. But who's going to argue with them? Who's going to argue with them? And he's been working with them as well, So that's the natural ally. And the good thing is a good chairman of the audit committee not only knows the tricky things, but has more than a typical CFO presence in a board. Because what are all the other board members scared of? Signing off on the annual report. For the rest, they can just have minutes and talk and do committees and make a contribution and ask smart questions and what have you. I'm slightly exaggerating. I'm bringing in the CFO perspective. I think they do more important work than the CFO, but you got my point from a CFO perspective, right? But the moment of truth for the other members of the board is to sign off on the annual report. For the rest, they are not going to be held accountable unless they really, beat people or steal money or do something really nasty. But for the rest, they're going to be held accountable now at the maximum. And all of them are situated in Delaware or whatever legal position. So don't worry about that. But signing off the damn annual report, ding! That keeps you awake. And if you are not a financial guy, but you're sitting in the board, of course, if you're in the board and you don't understand finance, go find another job. Doesn't mean, but you cannot know it in depth. So it's scary, isn't it? These 300 pages that are growing and growing. These days you don't get them in print. You get them on the internet. And you sign off on it as a board member. That within reason, blah, 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 blah. You say it's correct. That should be the high day for the CFO every year. You're going to sign off? That's the one moment it turns around. So you can see that the chief audit committee, and you typically have one or two people sitting next to them who are really knowing what they're doing. Because they delegate. If you have derivatives, you need somebody who knows derivatives and how you book that. Or if you do off-balance financing, there is somebody who's figured out how to do that. And they typically sit in this audit committee. So this smart chairman of an audit committee delegates that work. And that's the moment, that's the glory moment for finance and economists, guys. Now, the topic most of you are talking about, I don't know if I'm anywhere right, is the tax paragraph. Nobody wants to talk about the tax paragraph. Nobody. You can't, it's well, the worst in a board, I'm slightly moving, I can tell you what the worst position is in a board. And if I blah, 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 and should it really be 80 million? And why you do that? Can you comment on that?
No comment.
No comment. Okay, no comments based on the remuneration package of the... You always lose. Clear? And your colleagues are going to hate you because they know it's a horrible thing in the remuneration. So that's the worst position. So you can get these guys on the other side of the table. The remuneration committee is your... So what do you do as a CFO? How can you be an effective board player as a CFO? Number one, you don't become friends with the chairman of the audit committee. So don't talk buddy, because everybody will kill that line. But you should talk offline, get them involved, don't be afraid. Get the CEO out of the discussions on whatever you put in the audit committee. The audit committee is yours. Right? And if you really want to scare them, bring in the tax dossier. And maybe I have a new one now since I met you. Bring in the international transfer pricing issues. Because you know this, so I shouldn't elaborate on it too much. But the tax dossier was something, can we sort of, is this important for shareholders? These financial analyst guys, they sort of put in their spreadsheet, whatever they want to put in, and they put in 20% taxes. And they think that taxes are... what is a business tax? But most of the taxes are absolutely not business tax. But for some reason, everybody has been focusing on where the money is not on the business tax. The tax is on VAT, the tax is on Social Security, the tax is on what have you, not on... So, but for some reason, people find it more sexy to talk about these ingenious schemes of... But it's from a business perspective, I think it's ridiculous. So they focus on the totally wrong topic, number one. Number two is, if you look at the annual report, you remember the moment of truth sign-off. What does a typical paragraph say in an annual report on taxes? It's your job. What's in it? What does it say? Any help from me? Because I just studied. Yeah, what does it say? All answers are good. This is your field, not mine.
That the tax charge represents the fair allocation of local tax expenses accumulated on an effective tax rate.
Correct. So that helps. And okay, so we can leave it there. But the other thing is, since it takes forever, if you don't have rulings or whatever, it takes forever. You put something in the text, it always has huge paragraphs basically on what may be issues that are not involved, or it depends upon the ruling of the UK tax authority. It depends on the ruling of this and this. There may be some risks involved, but we have mitigated somewhere in the balance sheet. We don't have a clue. So the thing is, while your tax dossiers goes over years with all the legal stuff with it, your reporting is on a year or a quarter. So this is one of the horrible, while you're a board member, not in an audit committee, signing off on an annual report, the tax, no clue. So nobody has asked you. Nobody has asked you to do it, and that's the thing that's happening there. What's happening with the tax thing, and I think you talked about the OECD, you know much more about than I do. But what's the topic there? Is number one is, now as a board member, or as a board, we need to think about something called fair taxation, or having a license to operate, or being a global citizen, or, especially if it's US, you have these issues that if you do something wrong according to them in another country, you're also in trouble. So that makes it very tricky. So that's an item, what's fair? But if we are going to go to what we may think is morally right, or we connect it to the amount of activities or the amount of value-added activities that we do, and that should be of the overall taxes that we pay, sort of the percentage that we pay in that country. If we do that, on a competitive angle, we're going to be dead. So this is a catch-22. This is horrible. And now I need to have an opinion on that. Not only an opinion, you need to explicitly state what your ideas of fair taxes from a governance angle, not how it's implemented. No, what's your view on taxes? Especially the Europeans are horrible with this. Because in the US you can say, we're very aggressive on taxes. That's what we do. So you understand the risk as a shareholder. In the UK, in the Netherlands or whatever, there's more a moral appeal. That it should be fair. Whatever that means. But you're in a competitive angle. And then we all know, and you're at the heart of, I think, a great business. All these auditing systems, what I learned in the past, and you know this much better, is you had two ways of accounting in a firm. One is the accounting, that would sort of result into some consolidation and some business unit performance types thingies. And then you needed basically some older guy or woman who could run around to make sure that all the bookings were done properly in all the systems around the world, to make sure that it somehow miraculously would fit the 3 or 4 guys in the corner office that are doing some things nobody knows about in dealing with the taxes. So it's called? Plugging. Okay. So you basically had two systems and then the third thing that was real fun, you used to have the idea, at least I had, that these tax authorities, that they have trouble on their own. So let's assume that they do not talk too much to each other and worrying about their own careers. But guess what? They started talking to each other. That was not a good idea. And basically because they're now the heroes of the society, the tax collectors have become, you didn't want to be seen dead with them. But now they're the heroes of the nation because they bring in the money to reduce our budget deficits and keep all the other civil servants working. I'm talking Western Europe, I'm not sure about the rest of the world. So they have become heroes. They've become the heroes at the finance, at the ministry department. It doesn't matter where the money comes from, as long as it comes from somewhere. So I'm sure, I only have small, but it must be that you may have lots of business opportunities or lots of business with these bizarre background rules that the tax guys are now inventing. I don't know what they come up with, but I'm sure they come up, oh yeah, but in 2008 you had this tax arrangement, but now when we look at it in 2013, we don't think that this is fair because you didn't do something that you never knew up front that you should be doing. But guess what? We're gonna not only pay you the tax, but basically we think you did a wrong thing, so let's fine you to be sure for a certain angle, and we think you have an unfair advantage, so your company's bankrupt unless you just give us money now. I'm not saying I'm right, but I have been on the sideline with 2 or 3 of those issues and say, okay, I never thought tax collectors would have any fairness, but we're getting there. This is great business, isn't it? Does this help you a little bit? Probably not, probably does, but I think you have a marvelous angle with this transfer pricing, because the final thing that I know, and wherever, and it's not from a board or it's not from a governance perspective. In almost all companies that I've worked with, from a pure consulting perspective, not a governance perspective, pure how do you get a better business or how do you survive or things like that. Most of the CEOs do not understand how they allocate cost. Most of them have some bizarre software package out of the 1960s that sort of allocates cost and has been corrupted over time for tax reasons or for shifting somebody's career needed not to show a loss but needed to have a profit, or they reallocated, or they did something else. And it's almost all of the time, I hope you have better clients than I have, it's a one-dimensional factory-based software model, preferably not talking to each other in the different countries. And what most managers, and then I'll conclude with that, what most managers don't understand properly, and even most CFOs don't understand, and CEOs not enough, is if you do not change your allocation system within your bookkeeping, every change you want to do in your company is going to go down the drain. The disadvantage is the moment you do it, you end up in all kinds of historic debates on, yeah, but we always want and isn't that a wonderful business opportunity for you? Just to have people talking about it. And they say, let's fiddle something out that's actually impossible to fiddle out. isn't that the great? We're no longer consultants, right? We're professional service, and we help you meeting your wife and doing things like that. So I hope, I wish you very good business. And if you think I was totally bananas, just let me know. And it's entirely different. And I'm very curious about how your collaboration will go on, because that's what I really find interesting. This was more a CFO governance angle. But all put aside, what I find by heart very interesting is how do you get a company or people working together with whatever's happening in 2013 to create a business, to create an economic value, to create a social value, to create fun, and try to bring our societies forward. And let not taxes intervene too much with economic and social realities. However, it's going to take 5 more years before we understand that the solution we're trying to create with OECD or whatever will generate a great bunch of new problems. Because every manager knows it's not about the solutions that you choose. It's about the selection of the problems that you're willing to face. Every solution creates its new problems. So from a governance angle, from a professional services angle, from an academic angle, we're in the best business in the world. So have fun and hopefully contribute to your people and your society and your clients, because that's where value is created, nothing else. Thank you very much.
So, ladies and gentlemen, we're going to have a little break of 5-10 minutes maximum, and then we're going to return to start with the panel discussion. Yeah, so let's have a break, 10 minutes.
Fascinerend.